of people that have a net worth of over $10 million, the highest majority of their net worth, something like 26 or 27%, was in commercial real estate. So it's to show that, there's a lot there. And I think especially now when they're printing so much money and inflation, they're saying is 7-8%, when actually it could be somewhere between 10 and 20%. Yeah. Rents typically keep pace with inflation.
This week's podcast is brought to you by Spartan Invest. Spartan currently manages hundreds of turnkey properties across Alabama and Tennessee, and is where I personally bought my first out-of-state turnkey property. In fact, I have 2 properties with them now, and both tenants just renewed for another 2 years. That should tell you the quality of their team and their due diligence. If you are a first-time investor or are looking to expand your real estate portfolio, check out SpartanInvest.com.
Are you tired of the 9-to-5 lifestyle? Do you want more freedom to do what you want, when you want it, without sacrificing your current income? Then this is the show for you. Every week, we dive into John's journey towards financial freedom and everything he has learned since 2014. Real estate investing, cryptocurrency, stocks, private lending, foreign residency, tax saving strategies, infinite banking, assets protection, and much more. Now, here is your host, the founder of the Wealth and Freedom Nexus, John Rickgarn.
Good morning, afternoon, or evening, depending on when you're listening to this. This is John Rickgarn, your host, as always, of the Wealth and Freedom Nexus podcast. And again, we are joined by another great guest that I happened to meet on the Real Estate Guys Summit on Sand back in Belize. So obviously a little tidbit to anyone out there. If you get an opportunity to network with the Real Estate Guys and attend their annual summit, I highly recommend it. Now, my guest today also has a podcast called Mailbox Money, and is also a real estate investor as well, but has gone quite a bit bigger, deeper, and wider than I think I have gone, or at least at this point. Bronson is actually the managing member of Bronson Equity and is a general partner in over 1,500 multifamily units. Has spoken to over 1,200 investors, raised $20 million for real estate deals, wrote a book, and has a huge presence online with his YouTube channel. So with that, welcome to the show, Bronson.
Awesome. It's really great to be with you, John. Love talking about real estate. I know it's going to be a great conversation. So anything to do with you, man, it's going to be great. Economics and real estate and all kinds of fun. So looking forward to it.
Agreed. Yeah, same here. So now maybe Bronson, obviously, like I mentioned, myself, I'm just in, mainly smaller single family. My largest unit that I own is a 4-plex, and I've done, some syndications here and there as a limited partner. But maybe you can first, give my listeners a brief background on yourself and how you got it started into real estate investing and how you got to where you're at today.
Sure. So I actually became an accidental landlord. I had bought a house where I was living in another state. I'd moved there for a job. So I bought a house. And when I moved a couple of years later, I just decided to keep it and rent it out. And kind of reflecting on how that had done over the years, I was like, this turned out pretty well. So I started buying more single family houses. And I got up to about 4 or 5 single family houses in other states. I wasn't necessarily managing them myself, but I realized it was kind of a lot of work, even still just, getting the calls. What do we do here? And there's something called decision fatigue, where you can get tired of just making decisions. I don't know what I want to do with the toilet. I don't know what the tenants aren't paying.
Just
what do we do?
Care of it.
So just do it. I don't care. But you have to care about it because they're asking you what decisions you need to make. Mm-hmm. And so I was a well-paid professional. I worked in the medical field as a consultant. So I made really good money. Okay. And my goal was to get 30 of these houses and retire with passive income. And I have a cousin who was actually also at the summit, my cousin Wes, and he basically, said, hey, why don't you do multifamily? He's like, this seems like a lot of work doing these single family thing. And I said, well, I'd love to, but I don't have the money. And he said, well, you can raise the money. And he teased the guy, told me about the real estate guys. He told me about, different podcasts and books. So I just did everything he said. I started to meet up and, a few months later, and then I ended up finding my first investor shortly after that, who invested in one of my deals where we worked on a 225 unit in Amarillo, Texas, myself and some partners. And then actually at the summit, I really connected with somebody that I had been, kind of been really admired, but I basically said, hey, what if we work together to, help raise money and do big deals? And so we were able to raise about $15 million together over the next 18 months. And then I branched off about a year and a half ago, and we've raised about another 8 million since then. So
Wow.
it's been great. So I've learned a lot. Obviously, lots of things that, anybody who's honest and paying attention is going to say they make mistakes, they learn, they move on, and they grow. And so I'm just continuing to do that. And I'm excited for the direction it's going.
Cool. So now you kind of highlighted this both a little bit on the syndication piece, and then you're also general partner, raising the money and finding the projects. Obviously, we kind of hinted on the scalability where 30 single family homes might be a little difficult and time consuming to acquire versus a 130 unit or larger multifamily. What are maybe some of the benefits of multifamily investing, either as a general partner or as a limited partner, through a syndication?
Yeah, so I think when you get above about 60 or 80 units, typically you get to a size where you have some economies of scale. So you can actually have on-site dedicated people. If I have single family houses, I have to send, somebody with a property management company who does maintenance, who I pay 50 or 80 bucks an hour or whatever the amount is, and they've got to go to the house. They've got to, figure out what's wrong. Then they go to Home Depot, and then they come back. It's like a half a full day thing versus if you're at one apartment that's got 60 units or 80 units or 100 units. It's typically the same types of appliances, the same types of everything. It's much more. You'll have a dedicated person or maybe multiple dedicated people that just do maintenance on that particular property. So it's just much, much more efficient in that level. And then with syndication in general, some of the benefits are there's a lot of tax benefits where you can defer and pay less or no taxes or just defer the taxes that you'd get there. I would say, the returns to me, when it actually comes down to it, honestly, are comparable or better than doing smaller stuff. Typically because it doesn't always work out the way that it pencils on paper. You think, oh, this is going to be great. There's going to be no expenses. I'm going to manage this thing myself. And all of a sudden, when you have a house or a little house, like just the expenses add up. So these are much more financial type of assets that REITs and other really sophisticated individuals. They actually did a study and they showed that of people that have a net worth of over $10 million, the highest majority of their net worth, something like 26 or 27%, was in commercial real estate. So it's to show that, there's a lot there. And I think especially now when they're printing so much money and inflation, they're saying is 7-8%, when actually it could be somewhere between 10 and 20%. Rents typically keep pace with inflation. So large multifamily I see as being a very safe place where you can hedge inflation. These assets pay you to hold them, and you get a lot of in some ways unfair, or the government subsidizes you to hold. They kind of become your partner, and there's incentives rather than, I don't call them loopholes, they're incentives that they get to provide affordable housing. So many benefits to be in large multifamily.
Cool. Yeah, and obviously with larger projects, you can call them loopholes, call them subsidizations, whatever you want to call it. But you can get into cost seg studies like we had in episode 12 with Yoda Weiss, where essentially you can front load a ton of depreciation, and maybe investor puts in $100,000 and maybe gets $100,000 in tax breaks in year one, or maybe more, and it flows through on their personal returns. So yeah, anytime I can legally save on taxes, I'm definitely all for that. So now you mentioned a little bit, Bronson, with inflation, and I mean, I think you and I could both go down the rabbit hole of inflation. At the time of this recording, I think now they said it's not as high as they were predicting for February 2021, but it's 5.4% this month and 7.9% this month, and so on and so forth. But I've kind of looked at it, everyone seems to down inflation of, oh, my cost of living is going up, the groceries, gas, whatever. But depending on how you're positioned, I think you can kind of get to a point where you're benefiting from inflation. I mean, obviously you get the real estate appreciation, rents typically keep pace with inflation, maybe not in lockstep, but over the time. And I don't think it gets enough talking points, but with inflation, kind of even debases your debt as kind of like a third rail of benefiting from inflation. Would you agree on that?
Yeah. So my friend Jason Hartman, who's a real estate investor, also has a podcast. He calls it inflation-induced debt destruction. And so the idea is, how do you use inflation to your advantage? And what you do is you basically borrow at a low rate, which now can be 3-4%, when inflation is 8 to 20%, and you have long-term fixed debt. And it doesn't take a rocket scientist to realize like, wow, I can borrow. And I mean, simply, if you get, let's say you put 20% down on a property, whether it's a rental property or multifamily property, and the property appreciates by 20%, your value hasn't increased, your equity hasn't increased by 20%, it's increased by 100% because you only put 20% down. And so over time, and George Gammon, who was at the event, he also says this, that when you're looking at single families, I know you do single family, a lot of people do single family, is that if you can get 30-year fixed debt at 3 or 4%, the asset is not the house, the asset is actually the debt. Because over time, inflation and rates are going to continue to go higher and higher, and holding these things for a long period of time, it's very advantageous, especially if they cash flow. So I think that, in general, with all the money that's been printed, something like 40% of all currency that's out there was created within the last 2 years, either physically or digitally. It's only continuing to happen. I just did a video about this today, but it was talking about how they asked the current administration, hey, what, you said inflation was going to come down. It was a CNN guy interviewing Biden. And he said, hey, you being a smart guy or smart aleck or something. And then he's getting a little snipey with him. But then he said, well, if they just passed my $2 trillion Build Back Better, we'd give out money to this. And it's like, I don't think they just don't understand that the more money you create, it actually steals from the community. It's actually stealing from people that have money and savings. And so to me, it's like there's opportunity, but it also makes me upset and angry because it's like, this just feels so inappropriate to be just hurting, unsophisticated middle and lower class people.
Exactly. Well, and, I think inflation has always been referred to as the stealth tax. I mean, we've seen people get bracket creep where their, purchasing power is the same or maybe less, but then on paper or nominally, well, geez, I just bumped from, one tax bracket to another, and I'm paying more in taxes, even though my salary is effectively, the same for purchasing power. And, I'll probably tongue tie this, the inflation-induced debt destruction. I think that you mentioned.
Yeah, you got it. You got it.
Okay. I kind of look at it, it's like, okay, if I take out $1 million in debt, and let's just go really conservative and say it's 3% inflation, well, that essentially debases my debt by about $30,000 a year as far as purchasing power. And then kind of look on the bigger side, U.S. federal government, we're at 30 trillion in debt. Well, what, a 1% inflation? What does that do? Knock off, was that 30 billion, if I math, or $300 billion essentially off the debt every single year? I mean, it's just for what you and I can get from inflation hedging benefits, right, wrong, or indifferent, the federal government's going to benefit even more. And if we can position ourselves in the same boat as the Fed and the U.S. government, I think we're bound to be in a better position.
Yeah, I think you kind of nailed it there. It's just that, what is the government doing, and really paying attention to that. It used to never be that the Fed was such a big player. They were kind of more of they're doing this or that, but they become like everybody has to watch the Fed. And if you try to go against them, you're just not going to do well. But it really, I think you described it too. There's two ways you benefit by using real estate, by using debt for real estate, is you're basically, the value of the debt is worth less over time because you're paying back in future dollars, and the value is going to appreciate. So you get basically both. You get benefits on both, and typically cash flow will rise over time. So it's not saying that, you should be totally just throw caution to the wind and not look at just buy whatever. But a lot of people that I know that are very successful are just saying, hey, buy, like get out of cash. And there is a case too for having some cash, having some, dry powder there for a rainy day. And people talk about that. I think that's good as well. It's just, I think it's also like, I don't want to hold cash too long because I can see the cost of holding cash is very high.
Yeah. Well, and, so many people, they like to, we've been taught from a young age to save for a rainy day. It's like, well, if you're lucky, you can put it in a savings account, maybe get 0.5% interest. Well, even if inflation is down to 5%, you're talking a 10-to-1 difference. And on top of that, if you make so much as $10 in interest, you're going to be taxed at your highest marginal rate, adding insult to injury. So I personally like to put my cash in other, whether it's precious metals, investments, whole life insurance, infinite banking. I think there's a lot of avenues that one can do versus just stick in the bank account and literally watch it lose value day after day. This week's podcast is brought to you by Focus Wealth Group. Do you know you need to get life insurance, but don't know where to start or how much to get? Have you heard of infinite banking, but not sure how it works? Reach out to Barry Brooksby and his team. Barry is not only a mentor, but a friend who has helped me for the past 6 years in my pursuit of cash flow and financial independence. Their mission is simple. They teach people how to make money and hold on to more money. Learn more and set up your free initial consultation at focuswealthgroup.com.
Yeah, and I think that's the thing that a lot of people, we become such a debt-based economy that if you're not willing to go into debt, and I know people that they buy a home and pay it off in cash, and there's a couple of reasons why that's not a good idea. One is that you're actually more vulnerable to lawsuits because people do an asset search and find out that you have no loan on it, and they can find, especially in California where I live, where it's like everybody's suing everybody.
Oh, they never have lawsuits in California. What are you talking about?
Exactly. But then also, like, you don't get as much, you're not able to leverage versus you take 20% and you put it in 5 different houses versus having it all in one. But it's so for some people it can feel uncomfortable because they're taught that debt is bad. But I think, bad debt is bad. And Dave Ramsey is really good for a lot of people, and it's 101. But these days it's important. And again, I'm not giving anybody specific financial advice, but being willing to look at debt by, doing different investments, I think is something that everybody should consider looking at.
No, I agree with that. And, just the other day I was watching a YouTube video. I think the guy's YouTube handle is like Budget Dog CPA or something like that. But he was bragging that he paid off a house, I can't remember how many years early, and his interest rate was like 2.37%. And okay, some people just don't like debt. Okay, fine, teach their own. But, you're talking next to nothing for an interest rate and the way inflation's going. And I kind of chuckle when Dave Ramsey and his followers always say like, oh, well, I live debt free. And sometimes I just throw out like, oh, well, you must never transact in dollars because it says Federal Reserve note on the top of it. And I usually just get a deer in the headlights. Like you said, the entire system is, unfortunately, fortunately, right, wrong, and different is based on debt. So if you or I can't, what's the old adage? If you can't beat them, join them. You might as well position yourself to benefit from the effects of inflation versus just, being hindered by them.
Yeah, you're absolutely right. I have this bill up on the shelf here that's it's right up here somewhere, this $100 trillion bill.
Oh, yep, I can see it in Zimbabwe.
Yeah, and it's like, that's kind of what we're dealing with. Is it's just paper. It's just paper, and it's worth what people think it's worth. And I think what's going to happen at some point, people are starting to, and I think they're going to even more and more say, you know what, I just don't think these dollars are really worth as much as what I thought they were worth. And I think the mainstream, some people are starting to get that. And I think especially if we were to have some sort of stock correction or some sort of move with single family or other things, it would just be, people would start to kind of, and if inflation is still high, then people might start saying, hey, well, what do we do here? And that's where the case for things like gold or, cryptocurrencies, which I have been anti-crypto. I just bought my first Bitcoin recently.
Ooh, congrats.
I like real assets. Yeah, I know. So that's a whole nother conversation, but
crypto is definitely another topic. I know you and I networked with Courtney, the blockchain babe, as Robert Knowles referred to her as well. Had a really good conversation on episode 9, which ironically is I think my second highest, most downloaded episode at this point. So
that's awesome.
But yeah, I think for all of us, I'm speaking to us being here in the United States. I think some people are kind of looking at the US dollar, how much faith is behind it. And on one hand, I think there's two tailwinds we have going on. Right, wrong, or different, the US dollar is the world reserve currency. If you want to buy oil from Saudi Arabia, it's going to be settled in dollars. Most commodities are settled in dollars, whether you're in Thailand or Peru or Bangladesh or wherever. At the same token, history tells us that's not going to stay the same forever. I mean, the British pound was the world reserve currency. I think the Dutch guilder and, ancient Rome. I mean, we've had numerous world reserve currencies over the years. And probably the other thing at the time of recording, I think oil's at about $100 a barrel. We have the whole petrodollar that seems to be the new gold standard for the US dollar, where all oil transactions are done in US dollars. But if OPEC ever breaks up, if China and Russia form an alliance to trade more in, I don't know, yuan or gold-backed rubles or whatever the case may be, then I think the party's really going to stop and people are going to really question, is the US dollar worth as much as the Fed says it is?
Yeah, well, we really have. They talk about the unfair or the exorbitant advantage we've had. I mean, all the stuff we get at the dollar store or on Amazon and stuff has been so cheap, and it's started to come up, and people are starting to say, "Oh, things are getting more expensive." But we've had this incredible advantage that doesn't exist, even for Europeans. I mean, it's been really something that and I think the way we have handled it. I'm not saying it's right or wrong. I don't know what the right answer is during a COVID type situation, but I don't know. It's just we have things have changed a lot in a lot of different ways, and I think that to really evaluate what really holds value and what is wealth. I mean, even Chris Martenson would say from Peak Prosperity would say it's not money or even assets, but it could be actual goods. If you own barrels of oil or you own actual, farmland, or you own, productive farmland, or maybe you own like livestock or other things. Those are things that actually people need, and those are actually productive assets. So I think there could be a redefining of what really wealth is. And again, just because they print more money doesn't mean anything's worth any more. It just means that, there's more money and dollars chasing, I shouldn't say money, there's more currency chasing the same goods.
Exactly. Yeah. And I don't know, I don't know, maybe just been accustomed to this system so long. And I mean, personally, I don't think we're going to see a hyperinflation like the Weimar Republic or Venezuela. I remember years ago, I read about some guy in Germany that saw the writing on the wall, and he leveraged up. He bought a ton of real estate in Germany. And
Hugo Stinnes Hugo Stinnes is his name.
Oh, okay. Oh, thanks, sir. He was all right. But bought up just a ton of real estate. Inflation hit. Well, the mortgages get paid back in nominal dollars. It's like, okay, here's a 50 trillion mark note. Here you go. I'm all paid off, and now I have all this real estate. So,
exactly.
Yeah, but I mean, at the same token, I don't think it's improbable that we could see maybe more of a, I don't know, silent or creeping up inflation. I mean, right now, I think Turkey is experiencing 15%, quote, official inflation. I think Brazil, Argentina, Chile are in the 5 to 10% range. And, we've had that in the US back in the 70s. So again, I think if anyone can maybe just look at things a different view, maybe not look at all debt as bad, but if you can position yourself in a way to benefit from inflation, benefit from the loss of purchasing power of the US dollar, and get real physical, like you said, productive assets, then, I think your downside risk is pretty small at that point.
Yeah, exactly. Yeah. And I think it'll be really interesting to see. I mean, if inflation is not 7 or 8%, I mean, if you include rents, I think they're saying rent growth is like 3% or 3.5% when it's actually over 20%. So if you just change that one number, we're already at 15%. And so it's probably 15 to 20% right now. And it's kind of shocking, but the only way they resolved to squash inflation was Paul Volcker said, we're going to raise interest rates as high as is needed. And I don't think there's the political will here, but what happens if inflation gets to be, 20, 30, 40% a year?
Yeah.
I mean, is there going to be the political will to say, hey, the party has to stop, the music has to stop, everything's got to crash, all asset prices have to reset? Be very painful.
Yeah.
But on the other hand, what would that, we don't know what that would look like, but I know the longer that the party goes on, the more painful it is when it stops. There's a guy named, I want to say this real quick. There's a guy named Howard Marks who wrote a book, and it was called Mastering the Market Cycle. And he basically, whenever he writes anything, Howard Marks, Warren Buffett says, I always read whatever he writes. And I'm a big fan of Warren Buffett. So I read the book, and he has this idea of a pendulum. And he says that the further a pendulum, it goes, with market cycles, they go back and it goes forth and whatever. And it says sometimes it'll go so far one direction, it goes further and further and further. And the further it goes one way, it has to go the equal and opposite direction the other way. So I always try to look at that and think, okay, what direction is it moving, and what is how could this swing the other way, and how am I prepared? So that's why things that are not in dollars, things such as gold and silver and now a little crypto and stuff and some other things, just to kind of like, okay, what could I do well with, even if things do pull back? What is my downside here, which I think is an important conversation.
Yep, exactly. I couldn't agree more. And piling up on productive real assets, so to speak. I mean, myself personally, just last month, I bought into a basically a farm syndication of a citrus farm down in South America. It's like, well, I don't think oranges are going out of style anytime soon. So I think, and with commodities, they tend to keep pace with inflation as well. So, just having more diverse income streams and diverse assets, I think can be better for all of us. So now, Bronson, I know you yourself, and maybe it's more at the time of recording, you yourself have spoken to over 1,200 investors, by phone call, Zoom, in person. What have you, like, overarching, what have you learned, or what can you maybe kind of pass as a knowledge nugget for my listeners that you've learned from speaking to so many millionaires and so many real estate investors?
Yeah, so I did. I was able to, over a period of a couple of years, speak to 1,200 individual investors and 20, 30-minute phone calls. So you learn a lot. Just kind of, people have different, places they come from, but most of these people were net worth of 2 million or more. And so it was a real insight, just almost like, thinking like, wow, that was really interesting to just talk to that many people. And really there were three primary problems people faced when it came to who they were. And the first one was just typically people were very busy and they had no time. So either they were a busy professional, such as a doctor, lawyer, attorney, or they had a business, or maybe they were retired, but they just really, really valued their time because they had more money. They realized that time is actually more valuable than money. And while you can make more money, you can't make more time. So the ability to leverage your time or even leverage your investments through passive investing was really valuable. So that's why I teach passive investing. I teach people how to passively invest, how to evaluate deals. We do deals, but we do an educational component because it's so important that people understand what they invest in. Warren Buffett says we don't invest in anything we don't understand. And so it's important that people have an understanding. So that's one thing. Another thing, I'm going to forget my three things. I've got a whole presentation on this, but I know it so well, I'm probably going to forget it. But yeah, just the idea of really, leveraging your time, becoming more passive in your investing, not being the one that, if I make $100 an hour or $300 an hour, if I would, whatever the amount is, to really find people that can do work for you rather than you doing it yourself. So those are kind of a couple big things. And then another one was really looking at reducing taxes, because if somebody's a high earner, they can be paying 40, 50% or higher in taxes. And so there are ways, though, that you can get to where you pay zero in taxes. I paid almost zero in taxes, less than 1% over the last couple of years. And I did it through investing in real estate investments and using, you mentioned cost segregation. And, you have kind of these two buckets. So one is on the real estate side. And then if you can, against your ordinary income, there are certain investments in the energy space, or if you or your spouse qualify as a real estate professional, which is an IRS designation, you can use these passive losses over here from, multifamily and other sort of syndicated investments against your ordinary income. So I think those are a few things that are really important to people that are high net worth.
Yeah, no, I couldn't agree more. And ironically, you said that earlier today. I had a recording specifically on the real estate professional status with TPA that specializes with real estate investors. So it's definitely a nice little litmus test to hit to get some additional tax benefits. And obviously, you said tax savings accompanied.
But it almost sounds too good to be true. I mean, until you actually have done it, or somebody has done it, it's kind of like, well, like, how does that even work? I don't want to be audited. I don't want to go to jail. You're thinking about this, but then you're like, what it comes back to is, and I think it is really important that we look at, these are not loopholes for like the wealthy. These are actually incentives the government builds into the tax code, and they really exist. If you listen to Tom Wheelwright, he's a CPA, talks about these are incentives they put in all over the world to help, with creating low-income housing, to do things in energy and things like that. And so there are things in there that actually allow people to pay less or no taxes. And so when people hear about it, they're shocked. And that's why, when some of these politicians that pay 40, 60%, why doesn't Trump release his taxes? It's because he doesn't pay taxes, and if he does, then the CPA is not doing a good job because he owns his real estate guy.
Well, I think back to when Mitt Romney said, back in, was it 2012 election, that he paid like 13% taxes, because a lot of his stuff was passive and dividends and nothing illegal, but he just got crucified for it. It's like, well, if he got crucified for only paying 13%, I can only imagine what they do if they release his tax return, Trump's tax returns of here's 0% or point something percent. But, it's just all about perception. But as far as the government's concerned, society, we need food, we need jobs, we need housing, and we need energy. And if you can help to provide one, two, or all of those, more benefits to you. So
Yeah, for sure.
But, all right. Well, as we wrap this up here, Bronson, I want to thank you again for taking time out of your schedule to join us. If anyone listening to this may be interested in, reaching out to you, learning more about you and your kind of educational channel, and possibly investing alongside you in a syndication, what's the best way to reach out to you or find you?
Yeah, so I'm on YouTube. You can search Bronson Hill. I have an active channel there, creating about 10 videos a month there and interviewing guests, kind of like you do here, the Mailbox Money Show. We put them there. We also put them on iTunes. And then I have this report, which is the single best investing strategy during and after pandemic. It's 24 color pages, and you can go and download it. Just gives all kinds of things about the unfair advantages of investing in multifamily syndication. So happy to reach out, connect with anybody. And it's really great to have a conversation with you here today, John.
Sounds good. Yeah, I appreciate that. And for all of you listening while working out or on the road, I'll have all these links for downloads here in the show notes. So with that, Bronson, it's been great to catch up from the summit, and we'll hope to talk to you again soon.
Sounds great, John. Thanks so much. Appreciate having me on.
Thank you for listening. Be sure to share, rate, review, and subscribe on your favorite podcast platform. For more updates, check out www.wealthandfreedomnexus.com. Remember, nothing on this show should be considered tax, legal, investment, or professional advice. This show is produced solely for educational and informational purposes. Please consult an appropriate and licensed tax, legal, real estate, or business professional for specific advice for your situation. For distribution or publication rights or media interviews, please contact the host.